So hello everyone, and welcome to the first fireside chat hosted by Abatable. I'm Valerio Maiulo, co-founder of Abatable. Abatable is a carbon procurement platform that connects carbon project developers, intermediaries, and companies on the voluntary carbon market. I'm joined today by my co-founder, Maria Jania Filmanovic. And today's fire chat is in conversation with AlbaCore Capital Group. I will let Matthew introduce himself and AlbaCore as well.
Great. Thank you for inviting us. It's great to be here. My name is Matt Corey. I'm the COO and a founding partner at AlbaCore Capital Group. We are a 9 billion credit manager based here in London, and we built our firm from day one on principles and values, including dialogue like the one we're going to have today. So it's great to be here.
Thank you, Matthew. And Deborah, do you want to introduce yourself as well?
Sure, thanks, Valerio. I'm Deborah Cohen-Malka. I'm a partner and portfolio manager at AlbaCore Capital. I was part of the original team that came from Canada Pension Plan Investment Board to form AlbaCore five and a half years ago. And part of my job on a day-to-day is also making sure that ESG is fully integrated within our investment framework and within our credit research.
Fantastic. Thank you both. And I think actually that's a really good starting point. Perhaps, Matthew, would you start the conversation by telling us a little bit more about AlbaCore's ESG strategy, how it has evolved over time? And I think in particular, it would be really interesting to understand how that differs at the corporate level and at the fund level.
Yeah, our strategy really does have two elements to it. It's how we run the firm internally, and of course, how we apply our ESG principles to our funds and their investments. First, as it relates internally to our AlbaCore team, our ESG strategy starts with our people. We're focused on educating and engaging our team through events and training. Sometimes we'll do intelligence gathering surveys to frame these sessions to make sure we're staying exciting and relevant. The sessions, of course, can be informal drop-in sessions, newsletters, or lunch and learns. I'm proud to say that we now have a 20-member ESG committee. It's very popular, and it's also a key to future-proofing our business. Within the committee, we have 6 thematic working groups with committee members representing every single vertical at the firm here at AlbaCore. So I'd say it's safe to say that ESG principles apply across the business, from compliance, regulatory reporting, client service, and of course, risk management. Finally, I'd highlight that we have an engagement strategy within the industry, not just with investments, which Deb will talk about in just a moment, but with our peer group, other service providers, and data vendors. For us, a key idea here is to develop a common language to collectively try to answer some of the difficult questions we're starting to tackle. How do we properly measure externalities? How do we translate carbon emissions into basis points so that we can compare carbon-adjusted returns? Common language is needed, and we feel very strongly about being an agent of change on this front. So in short, I would say educate our people, develop policies and procedures across the business, and engage folks within the industry to develop a common language. And with that, I'll turn it over to Deb to talk about our ESG strategy on the investment side.
Thanks, Matt. I think that was super helpful. But from an investment standpoint, I would say it's really interesting because people are now very focused on ESG, but as a team coming from Canada Pension Plan Investment Board, we've been doing an ESG for over 10 years. And so when we started AlbaCore 5.5 years ago, it was only natural to us that there would be some ESG section and some kind of risk-based approach within our credit research and within every investment memo that goes to IC, to investment committee, sorry. There is an ESG section. From there, we have improved. We've just got more knowledgeable about ESG metrics, about potential risks, potential due diligence items to focus on. And that's now a big part of what we're discussing as well during our investment committee. I would say the second layer of it that is really important is the monitoring, because while we assess the risk at entry, we also need to monitor and see where is this going. And so we have built our own proprietary risk system whereby we're going to rank every credit from a high, medium, low risk perspective, from an E, from an S, and from a G perspective. And the aim for that is to make sure that on an ongoing basis, we're going to make sure that the things that we had identified at entry either are getting improved or make a decision or see how we can make it change. And that, I would say, is a good segue to the third point, which is engagement. As Matt was pointing out, he was talking more about the corporate framework and the industry engagement, from my perspective, the key is the engagement with our portfolio companies. And so just making sure that we have the right framework and the right discussions in place with our companies, with the management team, with the sponsors, in terms of how much we care, what do we care about, and how we can help them to frame the discussion. And that's been like a core part of what we've been doing at AlbaCore, I would say, for the past like 5.5 years to make things change. The part of the engagement that has moved and that we've seen a change on like for the past year is really the emergence of ESG margin ratchet loans or private debt securities with some kind of like sustainability linked KPIs. We have embraced that as well because we think, you know, it's good to start somewhere and it's important. And so if you're looking at our CLO strategy and our syndicated loans, like 20% of our CLOs right now are within companies with like ESG margin ratchet loans. We also have personally underwritten a sustainability-linked margin loan, like for a margin-linked loan for a company in the digital healthcare space called Babylon, and we're very happy, like, you know, to embrace like that aspect of the engagement part as well.
Thank you both. That was a very comprehensive overview. I guess, Deborah, you touched a lot on some of the aspects of how you operationalize the sort of ESG strategy at the investment level. And clearly, AlbaCore being sort of a debt investor, there's a lot of interesting approaches to that. How do you see the different nuances to implementing ESG strategy between a debt and an equity investor?
Yeah. It's a good question because, look, I'm not going to lie to you, we're not equity investors. I can't dictate what a management team is going to do. That's not what we do. Now, by having discussion, we see that like the fact that it's important for us and that we discuss like with our counterparties, if it's the equity owner or the management team, we think we can help the change and make an impact and go for the improvement. Because like if people see that what we care about, that we have a framework, that, you know, we need to have like some kind of transparency and some kind of engagement between the two parties to go for a better outcome. At the end of the day, it's in the interest as well of the equity or of the management team to make sure like they have like a lender that is happy and then can provide like the best execution on the debt instrument to maximize return on the equity side. So yes, like, you know, we're not going to be the first, I would say, like layer of like making the change, but we can help the first round of people to make that change.
Thank you. That was really helpful. And so I guess, Matthew, perhaps like diving a little bit more into the E in ESG, can you tell us a little bit more about how AlbaCore is looking at climate risks and opportunities across its fund investments? And I guess an important thing would be to understand why is this important to AlbaCore, the motivation behind it, and how did you get started on it?
Sure. Yeah, look, the E and ESG are, you know, the environmental part of this conversation is on everyone's minds, including obviously our own, and rightfully so, as it impacts everyone across the planet, including everyone who's on this call today. As credit investors, you know, we are important and significant stakeholders of the companies in which we invest, and as such, we have a key role to play with the problem of carbon emissions, alongside other investors, regulators, governments, other asset managers. We all need to be involved in pricing this externality and mitigating the free rider problem. And what I mean by free rider problem is the price of carbon mitigation is not zero. When we look at our portfolios, their risk profiles and their return profiles, there is a cost sitting in nearly every position. And at the moment, it's priced at zero. And we're gonna have a lot of interesting conversations in the coming years about what the right price for carbon is. But the one price that is not right is zero. So we wanted to develop a quantifiable, actionable, and repeatable process to address the carbon footprint in our investments. As part of that process, we believe the right strategy here is reporting in tandem with your asset manager and offsets in tandem with a specialist provider. It's an approach that can help credit investors keep pace with other asset classes and make it possible to do relative value analysis on a carbon-adjusted basis. Again, this idea that we need to develop a common language to tackle this problem comes up for us. Our vision is that in the future, the carbon-adjusted return will be a standard metric for investors. Carbon-adjusted return. We're in a world where the regulatory environment is changing rapidly, where accounting standards on the environment are being drafted. This can't be ignored anymore, and we'd like to be a thought leader in this space. We have to start somewhere. Talking about carbon-adjusted returns is a way to develop that common language. You heard it here first, carbon-adjusted returns. For us, this is where the conversation needs to start.
That's fantastic. Thanks, Matthew. And I think you've touched upon so many different things. We'll have time to follow up on all of them. But perhaps like picking on one of the first things you said, and you mentioning the use of offsetting. Obviously, AlbaCore has been quite a pioneer in the industry. You've been offsetting your operational footprint, I believe, since 2018. So you tell us a little bit more why you decided to do it, as well as how that offsetting program has evolved over time.
Sure. If we want to advance the conversation on how to price the carbon externality for our investing, we absolutely need to have our own business covered. That's how we're thinking about it here at AlbaCore. Beyond that, it's also something that our team advocated for. Offsetting aligns with our beliefs as a business, that we need to be responsible for the impact that we have. So we've neutralized our operational footprint through purchasing offsets. It's a portfolio of both nature-based and industrial carbon removal solutions. And we're geographically focused on Europe and in North America, in line with our business. Two interesting takeaways from this process of both measuring and then buying the offsets for our operational footprint. The first is if, as you look at the offset market and recognize the benefits of that market developing from where it is now, it's not hard to see that the financial community has a role to play. Many key themes in the development of the offset market, things like standardization, assurance, accounting frameworks, a portfolio approach, regulation. These are themes that are very familiar to those of us who work in finance. And so I think that's certainly one major takeaway, that there's a role to play in the evolution of the offset market as financial professionals. The second one is, as Mark Carney highlights in his recent book, if you can measure it, you can manage it. And I think certainly thinking about the process of the different pieces that went into measuring our own carbon footprint, and then thinking about, well, what are the operational ways that we can, minimize it? Things as simple as obviously taking fewer flights and doing more Zoom calls. Those come out of that process of measuring your own footprint, going through learning how the offset portfolio works. And I think, again, putting information in the right places so that you can start to make actual decisions makes a big difference. And that came to us through the process of doing our offsetting program.
Thank you. And I think you touched upon a lot of really interesting concepts. You touched upon standardization, assurances, portfolio approach, and all of these sort of speak to a lot of the concerns that we hear in the industry with respect to carbon offsets and the fact that they've gotten their fair share of bad reputation. So Maria, perhaps what were the main considerations for selecting which projects to use for AlbaCore's carbon offsetting? And just more generally, how can companies navigate to best of their abilities, the complexities of this market?
Yeah, absolutely. I mean, carbon offsetting is definitely a topic which has seen a lot of criticism, and we understand, it's a nuanced and complex topic, particularly given the lack of transparency we've seen in the space. And sort of we truly empathize with some of the challenges corporates have had in navigating such a complex market. Corporates are very aware of some of the bad press that has come around carbon offsetting. People might be familiar with the Bloomberg article that came out last year that highlighted a project sort of requiring carbon finance for conservation activities, but then proving that it wasn't at risk of deforestation and ultimately not being additional at all. So this has really exposed some of the corporates which bought that project and others to reputational risk for not having done a level of independent diligence before purchasing the project. So I think despite the reputational concerns, we truly believe that carbon offsetting is a very powerful instrument. It provides a monetization avenue for project developers operating and developing projects, which can generally lead to some climatic benefit that is additional, whether it's in the form of carbon avoidance, of carbon removal that is putting us closer to a net zero target in aggregate. So, a lot of the innovation is happening in the space. New project types are requiring carbon credit revenues as a way to de-risk project implementation. And we've seen some that are using that as a way to cover for the green premium of their development cost before they get down development cost curve. So in terms of Abatable, we look at the selection of projects similar to how we would look at selecting a company to invest. We do a lot of diligence at the project developer level. We think a lot of the implementation, the risking happens by backing the right operators with experience in the space. And then we delve deeper into finding balance of evidence around criteria around the additionality, the permanence, governance structure is something we put a lot of emphasis on, ESG co-benefits, and certainly jurisdictional rights in the context of ever-changing Article 6 and jurisdictional frameworks when it comes to carbon claims countries. So in terms of, I really like the analogy that Matt was using with some of the similarities happening in the asset management space. I come from the asset management space. I was an investor in carbon project prior to founding Abatable with Valerio. And so a lot of the concept that really resonated in our funding was this ability of offering portfolios of carbon projects, not just to reduce potential risk tied to this, whether it's carbon delivery risk, especially if you're purchasing credits ahead of time before delivery, but predominantly sort of to help reduce geographical risk, help improve the impact profile of your program. And likely, a way this helps is also for the inclusion of more expensive, more additional carbon projects that through a portfolio approach can help you blend down the cost to meet your budgetary requirements.
Thanks, Maria. Thank you for that. So I guess going back to AlbaCore, so we've touched upon carbon offsetting, but that and climate contribution are just generally just one small part of your climate strategy, your broader climate strategy. So Deborah, could you tell us a little bit more about how climate change is sort of sparking innovation at AlbaCore, especially on the investment side?
Sure. I think it's interesting from a credit investment perspective, because everyone right now is talking about inflation in the broader market. But the reality is we need to look at every factor, and transition is gonna cost to companies as well, and it's part of the inflation risk. And so as a good credit investor, we need to be able to have the data around that and be more precise and get more transparency. And that's just good credit investment analysis. And so part of what we were trying to do is make sure, I would say, with the lack of data that is available today, we develop our internal model that is as precise as possible, that enables us to analyze our portfolio for carbon emission. And so we developed our own model internally with peer analysis and various things. But the key thing for us was because it's a transparency issue, we needed to have verification as well. And so verification is at the core of what we have, with a third party validating our model that we have developed. I think as far as we know, we're one of we're the first, or one of the first private market participants to offer such strategy and to implement that strategy within a credit portfolio. And we love to be a leader in that sector. We love to be at the forefront of any innovation, and so we'll keep trying to improve our modeling, to keep trying to improve any potential availability of data to implement a better strategy around that.
Thank you. That's actually such an interesting and unique proposition in the market. Actually, I'm sure many in the audience will have questions. So if you want to start adding your questions to the Q&A tool, we will look to answer them at the end of the session. So given how unique this proposition is, especially on the credit front, and Matthew, I know you've been sort of close to the conversation with investors and LPs, and so what has been the reception? What has been the feedback? Tell us more about that.
It's been very interesting. Yes, we've had quite a few conversations. Been a lot of work over the last 12 months, engaging, getting up the curve, engaging, and then talking to investors. The feedback has been broadly positive, which I'm happy to report, and we're certainly finding ways to implement solutions with a few investors, which is fantastic. A lot of these conversations have been fascinating to see how they've demonstrated the broad chasm, the large spectrum of different, let's say, levels of experience talking about these topics. I was on one call with a large institutional investor. I had the investment team and their ESG team on the same call. And I walked through the strategy, and someone on the investment team said, well, what is an offset? I've never heard of that. And then in the same call, someone from the ESG team said, oh, I've looked into offsets. We don't believe in offsets. We think you need to go directly to cutting down all emissions from the get-go, period, paragraph. And that was obviously a robust conversation, a very healthy one in lots of different ways, but shows you how different the backgrounds are across the industry. In one case with an institutional investor, I'm proud to say that the conversation we had on reporting and offsets actually made it to their executive committee for consideration, which was a good achievement. The feedback we got from their governing body was that they deemed their fiduciary obligation to their investors to dictate that for now, reporting and offsets wouldn't be a part of their strategy. The key thing for us is they wished us well, they told us they hope we're successful, and we're still in dialogue. It's a conversation that's continuing to happen, and I think to have that high level of engagement with a large institutional investor as part of these ongoing conversations we have, I thought was a great sign of the direction of travel. I think my main takeaways from all the conversations that we've had are, I guess, first, there's a ton of publicly disclosed carbon data out there, but we're a long way to go in terms of disclosure and consistency of that data. But you have to start somewhere. Doing nothing is not an option, and we think that there are definitely sufficient data and sufficient systems at this point to put in place quality reporting and offsets. And second of all, I think the most important takeaway is that investors want to learn more and understand the environmental impact of their portfolios, and we feel that in that respect, developing a common language is essential to getting aligned. It's essential to setting intentions, and it's essential to creating change as an industry.
Thanks, Matt. And just speaking on what you just said, it does sound that the success of this strategy really relies on the ability to successfully measure and monitor the carbon intensity of the investments on an ongoing basis. And this is something that seems like to be also quite table stakes for the investors. So what was AlbaCore's approach to this, and what were the main challenges?
So look, in summary, our research analysts conduct a calibrated peer analysis for every investment in the portfolio based on a broad base of company carbon reporting out there. Putting together this framework, you talk about challenges, were obviously quite a few challenges in the process. First and foremost, the biggest challenge was getting up the learning curve. Talking to experts, reading up, all to create a reporting transparency that's both suitable but also deliverable. Second, you're working with often inconsistent availabilities of data. So obviously many private and public issuers don't measure their own carbon footprints or publish them, but you have to start somewhere, and pushing ahead with the data sets that we had was essential, and that was definitely one of the big challenges. Third, there are a lot of acronyms. We are a signatory of CDP, we're a supporter of TCFD, we've drawn from the PCAF or PCAF methodology in assessing emissions. So, I mean, nothing new for those of us in finance, but I would say, as you start to learn about, the climate world, there's going to be a lot of acronyms, IPCC, et cetera, you're going to have to learn. But in all seriousness, I think having a lot of conversations has helped shape that common language that we think is essential. And in answering difficult questions, you need to be using the same language. Thinking about how carbon conscious investing, reporting, and considering offsets can translate to the primary market, for example, is a great challenge, and one that needs a common language. If you could tell a new issuer, hey, you'd be a 6% issuer, but pricing in your carbon footprint, you're a 6.5% issuer. Creating a transmission mechanism like that to get portfolio companies thinking harder about how they can manage and mitigate it at the operational level, that would take a common language across the industry. So there's a lot there, but those are some of the key challenges.
Thanks, Matthew. And I think you mentioned a lot, sort of educational piece and sort of actually using a common language to make this a success, right? So Maria, zooming out a little bit, what do you see the role of asset managers, and what role can they play in the carbon markets in sort of supporting the deployment of scale of more carbon negative solutions?
Yeah, absolutely. I mean, decarbonization investments are growing fast, not only because a lot of the asset managers have committed to initiatives such as the Net Zero Asset Manager Initiative or the Glasgow Financial Alliance for Net Zero, the GFANZ, really seeing a strong momentum in terms of commitment from the asset management community in committing at least 130 trillion of assets to be net zero by 2050. And this is not just across the operational footprint of the asset management itself, but it's also across their investments. So suddenly the volume we're dealing with is substantial in terms of influence sphere, but also potential footprint. And a lot of asset managers are going through a hierarchy of priorities, and rightly so. They're trying to push new products around decarbonization or abatement initiatives, whether it's renewable energy investments or any sort of abatement investment from that perspective. But if we think about the global problem of climate change, currently we know that 30% of emissions will be hard to abate with current technologies, and so require a level of setting now, and the actions will need to start now rather than postponing it to the future years. So what is interesting is we've actually seen, outside of decarbonization, investments being pushed. Some very innovative asset managers start thinking about carbon neutral funds, whether it's by offering new products to investors that allow them to opt in, compensate their emissions into the new product designs. And that's often being resulted in a modest higher management fee being passed on or split between the asset manager and the investor. The other structure we've seen that is pretty interesting is for some asset managers to have taken a portion of their carried interest or performance fee and put it into a charitable pool that allows them to invest in carbon offsetting projects. So we see a lot of momentum around carbon neutral funds. Certainly a lot of the innovation, I think, is coming into the asset management world ahead of other sectors. And a lot of, as we spoke, a lot of eyes and trying to prioritize this sort of innovation also to cater for increasing demands on the investor side.
Thanks, Maria. I think it's really helpful to just sort of frame it and just more broader strokes what the asset management industry as a whole can do to contribute to the problem. And so, Deborah, going back to you and to AlbaCore, it obviously sounds like climate change is a really key consideration for innovation at AlbaCore. Where do you go from here? And what are generally the future plans for continuing to deliver on your climate strategy?
Yeah, I mean, we want to make it better. So we'll continue to work on our carbon conscious strategy as the data becomes more available, improving our framework, and just like trying to lead the change and innovation. I think I would extend actually, like we had to start somewhere, and so carbon came first, but like there are other aspects of it, like of environmental change that we could help on that could be next on the list, but that's where really we're focusing on. I think second point, we'll still work on the engagement because we think that's where we get like the best results, to be honest, if it's with like the portfolio companies or the sponsors or industry bodies. We actually sit on the board of the European Leverage Finance Association and on their subcommittee for ESG, and we're trying to help standardize the industry around ESG and around like borrowers and high yield markets. And I think like for the last point and really important, what we have today is on the private debt like solution is already great, and if we can extend that like to other of our strategies, we would. So we're exploring a few options if it's for our CLO platform or other credit products that we have.
Great, sounds like a lot to look out for in the coming year and beyond. So I guess before we take questions from the audience, it would be just great to hear both from you, Matthew and Deborah, on any advice you might have for other asset managers on just how to follow into your footsteps and how to get started.
That's a great question. I think first and foremost, you have to start somewhere. You can't do nothing, and in an area where you're navigating data sets that may not be perfect, but you have to start somewhere. Number one. Second, as we alluded to a bit, collaborate, ask questions, challenge each other, and engage. And just putting this opportunity into context, ESG frameworks are already becoming more quantitative. Deborah talked about the margin ratchets and those other scoring mechanisms, but the whole world of ESG is getting more quantitative. This whole climate topic and carbon in particular is a great opportunity for the industry to grow in that context. And as a final thought, I would say one great theme that we're seeing that I think should continue is that investment teams are starting to train to think more like ESG people, and ESG people are starting to train to think a little more like investment people. And that's exactly the kind of dialogue that allows us to be in a place where we can translate a portfolio's carbon footprint into basis points, into a carbon adjusted return. And I think that's how we're going to develop that common language. It's a great example of where we can get to when we work together.
Yeah, I would add to that, take the time, because I think, we want to see other people and other asset managers like join us in this adventure, I guess. But we've been working on that project for 2 years, and it's been like a lot of back and forth. It's been like some days painful, some days very rewarding. And so I think like it's really important to take the time to do the work, engage with the companies like you own from a credit perspective, understand where they are, and like try to help. I would say the second part of it is like just come and talk to us. Like if anyone wants to work together, we actually embrace the change, and so we're more than happy to collaborate and to get the help and the input from other people as well.
Fantastic. So it sounds like AlbaCore's doors are open, and so hopefully everybody will take you up on that offer. And with that, thank you so much for all the valuable inputs. I think we're going to switch to a Q&A. We've got quite a lot of good questions already coming in. So I guess the first question perhaps is for Maria, good to answer. The demand side is mostly from developed economies, mature companies and markets. Yet the supply side, carbon offsetting that comes with forestry, abatement projects, is located in developing economies or markets where ESG is not well developed or understood. What potential do you see for regional companies like in Latin, following a similar business model and offering carbon offsetting portfolios and ESG solutions to companies in developed markets like London?
Yeah, I think certainly with regional expertise comes a lot of important access and differentiated access, especially to projects, and particularly in developing economies where, rightly so, it was a highlight that the supply is concentrated into those regions. So I think what is interesting is we've seen some local operators or regional operators or asset manager companies really launch products that have the ability to generate carbon credits. So for example, just one thing that comes to mind is a forestry timberland fund has recently launched a timberland fund strategy focused on the region where the operator was. And an interesting thing that they're offering to the structure is also the ability to access carbon credits generated from those assets. So that's an interesting piece of innovation we've seen where clearly a lot of the regional expertise is brought to bear and brought forward to investors in developed economies, because we know a lot of the emissions typically tend to be focused in those regions.
Thank you, Maria. Next question, I think Matthew is probably best placed to answer, since you touched upon this already. How do you report the carbon footprint of your portfolio if not every company discloses this publicly yet?
Yes, great question. Obviously, one of the first items we wanted to tackle. So we use a calibrated peer analysis approach. So we look obviously across the thousands of companies that do. There are thousands and thousands of companies that do disclose their carbon, covering all GICS level 3, level 4 sectors. So there's actually a huge pool of data to look to, and our team of research analysts obviously has a very in-depth knowledge of every credit, public and private, in the portfolio, and so we calibrate based on obviously similar business model and obviously size as well.
Thank you. And then perhaps Deborah, you can take this one on. It's a very interesting question, and it touches upon something you already mentioned, which is sort of the collaboration with equity investors. So could you talk more about the collaboration with equity investors so issuers can be ready for carbon adjusted investments, and what would be an ideal issuer in sustainable real estate, for example?
Yeah, I mean, so in terms of like the cooperation with equity investors, it goes from the top. So it goes like when we're doing our due diligence, really. And so it's framing like the conversation depending on the sector. What could be like the factors that, depending on the sector and the companies, like if it's more like if it's a healthcare company, maybe it will be more in like medical waste, for example, than like some other element. And so just framing the conversation during the due diligence, like engaging with them, just spending time to understand what's the framework, if they actually have like something in place, just the fact that they have like an ESG policy themselves. And then it translates into, do you have like targets actually? What is your plan? Like some will have already that baked in, some not just yet. But from our perspective, it's always like from a risk-based approach. So what we're trying to do is saying, when we're analyzing it, like saying, okay, you might not have like the target today, but are you working on a plan? Because like this is coming in certainly core like to our credit analysis. And depending on the answer, we will tell them as well, like at this stage, we rank you like, you know, high, medium, or low risk, but like we think like in the next, over the next like 6 months or a year, you need to have like this plan put together, and we're more than happy to work with you on a certain plan, on what, you know, could be done and how we think about it. I think, you know, the more, I would say the reason why we say like we haven't done yet like our carbon conscious strategy applicable to CLOs, the syndicated market, where it's bigger tranches and we will have like less access like to management, for example. Like there needs to be an industry like standardization of the questions we're working on like with the European Leverage Finance Association, when it's like more private debt instruments, and we're going to have like a sizable position where we can dictate, and we can dictate on bilateral negotiation as well. We'll work on that. The second part of the equity investor engagement is just telling them as well, look, we'll need to have like somewhat like a margin ratchet or some kind of mechanism embedded in the documentation. And so we've done it, like, for example, on Babylon. Interestingly, it's not the first time we're doing an ESG ratchet flow. We've done it as well on the private side from a governance standpoint. But if we can extend that conversation with issuers and with equity and say, look, we want to engage, we want to work together, this is what we care about, let's put together a plan, like tell us what is our plan, are we happy with that? And if we feel there's a real shortfall, we can say like, you need us like to do that transaction, like we want to make sure we have like certain triggers or margin, and can be embedded in the documentation in different ways. We've done like margin step ups, you can have a discount if you're doing like the right target, and that's really what we're how the conversation is going with equity investors.
Thank you, Deborah. Maria, this question perhaps is a bit more specific. So which projects did you select together with AlbaCore to offset their footprint?
Yeah, absolutely. So I think the way we work as Abatable generally is we have a good sense on the different pools of developers that are out there. We've internally mapped a significant number. We maintain a database of different developers we like and score the developer level entity first. Then we sort of overlay that with specific requirements that AlbaCore in this case came to us with. And AlbaCore had a preference, as Matt mentioned, to back projects that are close to their business operations. So that means European project and North America project. And so we filter that database for those requirements. And where we landed was a mix of projects, predominantly sort of US regenerative agriculture, that are improving carbon sequestration profile in the soils, together with some CO2 utilization projects that are sequestering CO2 within cement manufacturing. And then we looked at some forestry project as a way to blend down the overall cost of the portfolio implementation. So that's sort of an initial stage of work. We've also done a lot of scenario analysis that potentially, you know, could inform the carbon adjusted returns. Clearly, you know, with the prices moving relatively fast, so it's something that we keep on feeding our customers with a lot of information and sort of helping get to a right portfolio implementation that meets budgetary constraints and impact requirements.
Thanks, Maria. And I think this question is somewhat related, but to the previous one, sorry. So thank you for your interesting presentation. At one level, it is important to talk about the big picture, but what are the practical solutions towards abatement and offset? And what are the current ideas attracting the attention of credit investors? Matthew, do you feel this is one you can take on?
I mean, I would say based on the conversations we're having, we're probably a step. The base of most of our conversations are not quite to that step. I think the earlier inquiry about like, how do I look at my portfolio? You know, what is the impact is kind of where most of the market is now. I do think this is the right next step after that, but I think in certainly the conversations we're having, it's not where most folks are on the credit side.
a last question. Maria, perhaps this one you can address. So with everyone rushing to achieve carbon neutrality, there might be more incentive to purchase nature-based credits, while solutions such as carbon capture, which needs capital to bring down the cost curve, might not be preferred. How can this be addressed by both asset managers and carbon offset providers?
Yeah, absolutely. We know that carbon removal needs to scale significantly from where it is right now. And unfortunately, this has been a result of the fact that there's not a lot of financing that goes into this project. It's perceived too high risk. What I was mentioning earlier was the fact that I think carbon offsetting could be a really powerful instrument in effectively channeling some revenue into these projects that need now R&D funding, essentially, as a way to de-risk significantly and get down the cost development curve. So part of what we deliver as part of our portfolios is really the inclusion of more innovative projects that contribute specifically to carbon removal from a technology standpoint. And we do that to blend down the cost. We blend down the cost of inclusion of those projects together with more cost-effective solutions, such as nature-based credits. So that's really sort of the value proposition we bring is access to carbon removal. We try to educate clients on how to understand the risks around not only the project developer, but also the project itself. It certainly is, the earlier nascency stage of development. So, yeah.
Perfect. I think that was a good wrap. I think we've run out of questions. It was certainly a very engaging and interesting conversation. So thank you, Matthew. Thank you, Deborah. Thank you, Maria, for participating. Thanks everyone for attending, and yeah, get in touch if there's anything we can help with, and also get in touch with AlbaCore. The doors are open for guidance and advice on their approach to climate strategy and climate risks. Thanks everyone.